The man, the myth, the legend, Warren Buffett. Considered one of the greatest financial investors of all time. Today we're going to explore how he made his money and his investing philosophy. But before we do that, we have to first explore his past. So now we're going to reverse the clock and go right into it. Born on August 30th, 1930, right in the middle of the Great Depression. The Great Depression itself lasted from 1929 to 1939. So my guy lived the majority of his childhood during the Great Depression, which affected millions of families in the US, including his own. His father, Howard Buffett, was a stockbroker, which definitely brushed off on the young Warren Buffett because even at an early age, he demonstrated a unique gift for business and finance. He was known as a math genius, being able to do complex math problems in his head, which will definitely become very useful in the earlier years of the stock market without computers and charting systems. This guy was an entrepreneur and investor from the start. He already had some of his first investments at the age of 11 years old, and even started small business ventures like being a paperboy, to later owning and operating a little conglomerate of pinball machines that he was able to sell for $1,200. Some of the schools that Warren Buffett went to was the University of Pennsylvania, University of Nebraska, the New York Institute of Finance, but even more importantly, the Columbia University. Why, you may ask? Well, Columbia University definitely isn't sponsoring this video, so I have no bias towards it. But the reason why I said this place may have been the most important place he studied at was because he met and learned from the legendary Benjamin Graham. You know, the one who wrote The Intelligent Investor? Yeah, that guy. Warren Buffett created his first firm in 1956. It was called the Buffett Partnership Ltd. His main strategy was to find undervalued stocks and companies, invest in them, and make money on their future growth. Easier said than done. One of these investments was Berkshire Hathaway, a textile company, which will later become his main focus after closing down his initial firm, the Buffett Partnership, in 1969. Berkshire Hathaway became Warren Buffett's vehicle to billionaire status, his magnum opus. So what he did was scrap the textile part by selling it for more capital and then use that money for more investments, turning Berkshire Hathaway into a holdings company. What is a holdings company, you may ask? Tell him, nerd. What a holdings company mainly does is have controlling shares of stock in other companies. And the companies under the holding company itself is called a subsidiary. Think of the holdings company as the parent company, and the other subsidiaries are the branches of the company. For example, one of the biggest holdings company, Louis Vuitton, has ownership and investments in many branches of fashion. One of his first acquisitions was an insurance company named National Indemnity. Yeah, I butchered that. And he soon expanded to other various sectors, including food, finance, media, and so on. His approach to this was similar as before, where he would buy undervalued companies that are going through tough times, which makes them cheaper, acquires them, and fix them up in order to profit off of the company's growth in the future. Some of his most famous investments include Geico, Benjamin Moore, Duracell, and you know, the queen of diabetes herself, Dairy Queen. An interesting thing that I found out about Warren Buffett through my research was that he had a bit of a hidden special ability called float. This float came from his insurance companies. The float is pretty much the money that consumers paid to insurance companies like car insurance and property insurance, you know, that has not been used to cover any accidents or claims yet. And you already know that Buffett would use this new pool of money to scale his investments into another level, almost predatory-like. But I guess you can say it's just the name of the game. An example of how he used this money to his advantage was his acquisition of Fruit of the Loom for $835 million back in 2002. Which was actually chump change because the company had actually dropped 97% of its value to get there. Warren has quite the knack for taking advantage of companies who have lost the majority of its value through recessionary and declining market periods, including his recent investments to capitalize off the recent bear market. His methods may actually loop back to his earlier years because he had actually lived through the worst market decline the US has ever been through, and had many more experiences with recessions since then. Through strategic investments and his unique outlook on the markets, he was able to build himself out of the financial uncertainty he experienced as a child during the Great Depression, to currently the 7th richest person in the world. He was number one once too, but right now my guy Elon Musk has a spot. Now I'm going to list off some of his biggest investments. Apple, Bank of America, American Express, Chevron, and in 5th place, Coca-Cola. Did you know that all 5 of these companies actually account for 70% of Berkshire Hathaway's portfolio? As we all should know by now, Warren Buffett was a true investor. He focuses on the fundamental analysis of these companies to determine undervalued stocks and invest in them long enough to profit off of future growth. He either takes a passive position in these investments and just allow them to make their own decisions, or actually works for the company to make them a better and more profitable company in the future. Warren Buffett is a value investor, and he uses 4 principles to determine the company's value. His first principle is investing in companies that he can easily understand and analyze. If the company itself is not too sure about themselves and their philosophies are vague, it presents a lot of red flags for him. The second principle is looking at the upper management of the business, the leaders of it. He wants leaders who are innovative, transparent, and prioritize the value of shareholders. His third principle is focused on the company's overall statistics and fundamentals, focusing on the company's potential and financial fundamentals that makes it possible for future success and growth and profits. The fourth and final principle is finding the true value of a company, also known as the intrinsic value. This is done by projecting future earnings and then discounting them into present dollar value. It's also important to understand that all of this should be accompanied with a lot of data and statistics, because you can't know any of these without a lot of data to back up your claims, because there's a lot of variables you're playing with here. And with Warren Buffett, with his billion-dollar empire and years of experience, he definitely has the data and computational power to help him in deciding his investments. And just another one for the road, since he is a long-term investor, one of his key investing philosophies involves patience. According to him, the stock market is a device for transferring money from the impatient to the patient. He's currently 91 years old and still kicking, man. That's goals right there. A truly rags to riches story that should inspire you to go out there and pursue your dreams. And don't be that guy that says, oh, he was a genius, I'm just a normal guy. In this day and age, we don't have to be geniuses to achieve something great. Maybe back then we did, but now with technology and computers, we all have the hardware and capability to achieve greatness in this world. You just have to try. I like to think that technology covers a lot of our flaws, from computational to memory. I mean, if you want to know anything, just fucking Google it. So with technology, all you need to do now is put in a little bit of creativity and some conviction. Good luck. Can't wait to see what you motherfuckers do.